In this video, I'm gonna go through my Australian dividend growth portfolio and answer some of the most commonly asked questions around dividend growth investing. Now, as you can tell,
I'm sitting on the floor because I don't have any chairs yet.
And I just moved into a brand new apartment. So once the office area is ready, I'll take you guys for a mini office tour. Now, as usual, make sure you gently destroy that like button because that will help out my channel out a lot. And without further ado, let's go. So how this video is going to work is that I'm gonna go through my dividend growth investing portfolio first, then I'll answer common questions like how are dividends paid, how are they taxed, franking credits, and how do you opt into dividend reinvestment plans. Now, with my Australian dividend growth portfolio, I don't go by my standard filtering criteria of a strong balance sheet, earnings growth, and also economic moat. That's just because the transaction costs here are really expensive. So I'm a bit more of a passive investor with my Australian portfolio with a few loosely held parameters. So my parameters when it comes to my Australian portfolio is as low cost as it possibly can be, dividend growth oriented, unless there is a stock I want to own exclusively, then so be it. And make sure that I diversify across multiple industries. Let me warn you that my Australian portfolio is by no means perfect, which means that there's going to be tons of flaws, and I'm going to talk about those flaws throughout this video so that you can learn from my mistakes as well. So what you see on my screen right now is the most recent snapshot of my Australian dividend stock portfolio. Now, if you haven't seen my US dividend growth investing portfolio, I'll leave a link in the description below. Also, I am dollar cost averaging. It just means that I am investing approximately the same amount into my portfolio, no matter the times are good or bad. So let's start with my three listed investment companies, Argo, Milton, and WAX. So Argo is the second largest listed investment company in Australia with over $5 billion in funds under management. Now, if you want to read their investment objective, feel free to visit their website. But their investment thesis is centered around high quality companies for a growing stream of dividends and capital appreciation. So that investment thesis is one of the main reasons why they are in my portfolio, because it just aligns with how I want to invest my money, especially focusing around a growing stream of income. Now, what you see on the screen right now is a portfolio breakdown. It's mostly in banks, materials, other financials, such as other listed investment companies and healthcare companies. So from a diversification standpoint, it's giving me access to multiple industries at once. So that's pretty good in my books. And this is their dividend payment history. Since 1986 to 2019, Argo's dividend have grown 6.3% for the last 33 years. And inflation during that period is about 3.1%. So far, so good. Now, all of the dividends are fully franked. Management fees are 0.16%, which is very low, by the way, and there are no performance fees if Argo outperforms the market. Now, don't stress out about franking credits because I'll give a full explanation in the frequently asked questions section later in the video. For now, just think of franking credits as tax benefits companies pass on to you for investing in them. Argo is currently yielding 6.55% gross, meaning that it's including the dividend payment and the franking credit. Again, don't worry, I'll have a full explanation on that in just a little bit as well. For now, just know that if you were to invest $100 in Argo in the beginning of the year, at the end of the year, you will have $6.55. Now, similar to Argo, Milton Corp's investment thesis prioritizes around building a diversified portfolio with a growing stream of income. Again, this is one of the main reasons why they're in my portfolio, but they are a little bit heavier on the financial services sector and the energy sector. Now, if you look at the dividend history, generally speaking, it has been trending upwards. Now, during tough times, they did cut their dividends a little bit, but have built it back up over time. So over the last 20 years, Milton Corp have grown the dividends by 4.9%, and the inflation over that period is 2.5%. So far, so good. Their management fees currently is about 0.12%, and definitely one of the lowest management fees out of the three listed investment companies I have. But the interesting thing about Milton Corp is that if you look at some of their holdings, some of them aren't even in the ASX 200. It means that Milton Corp is willing to take on more risk if they believe taking on that position will benefit the shareholders over the long term. As of recording this video, Milton Corp is currently yielding 7.21% grossed up, which means that the yield that I just mentioned includes the franking credits and also the dividend payments. Now, the yield is really high, just for your information, is mainly because the share price over the last couple of months have dropped significantly because of the public health crisis. Just remember that the yield is not going to be this high over the long term. So before we jump into the last LIC in my portfolio, I just want to let you know that this is something that I could have done better, and I'll explain that in just a second. Now, the last listed investment company in my portfolio that also holds 50% of my portfolio value is WAM Research. Now, WAM Research started in 2003, and their investment thesis is centered around undervalued small to medium-sized growth companies to provide investors with a rising stream of dividends along with capital growth within acceptable risk parameters. Okay, seriously, that's a mouthful, but what they really mean is that they're looking for small to medium-sized dividend growth companies. That's it. Now, what you see on their screen is their filtering process, which is documented in their prospectus if you're interested in reading. Now, this is the history of dividend payments from WAM Research. Generally speaking, it's been trending upwards. Yes, during the financial crisis, they did cut their dividends, but it got built up relatively quickly over the next couple of years, so it's still good in my books. Now, Wilson Asset Management, which is essentially the parent company of WAM Research, offers 6 LICs. Now, I picked WAM Research because of the dividend growth track record, which is approximately 8.3% per year over the last 17 years. Also, personally, I prefer what I'm invested in not taking any short position. With some of the other LICs, they do take short positions. It's just more of a personal preference thing. Also, what I was hoping to get from WAM Research is their diversified exposure to small to medium enterprises. And to be honest, just something besides our big 4 banks or mining companies. Now, let's talk about fees. The fees is something that bothered me, but it didn't stop me from investing. The management fees are a whopping 1% per year. And there's a 20% outperformance fee of whatever amount WAX outperforms the All Ordinaries Index by, which is the top 500 companies in Australia. But the yield is currently at 11%, mostly because of the drop in share price. But in the past, it sits anywhere between 6 to 8% yield grossed up, which is really good, by the way. Now, while the fees are high, it does make it up in yield and performance. Does that mean that they can keep up these kind of yields in market downturn events or in the future? Well, no one knows. But I think it could be a reckless move on my part to put close to 50% of my portfolio in WAM Research when I know that small to medium-sized companies are a lot more risky and their economic modes are not quite established yet, so chances of dividends being cut could be quite high. Now, truth of the matter is, this is one of the reasons why I'm working actively to add to my position in Argo, because I believe the track record of the companies within Argo are significantly safer, not to mention the cost is super low as well. So with the 3 LICs, it takes up approximately more than half of my portfolio. The main reason being is that the transaction cost is just really high, and I am more of a passive investor with my Australian portfolio. So let's talk about some of the other guys in my portfolio as well, because some of you have asked me, why are you invested in AMD? Why are you invested in InvoCare? What's the logic behind it? So let's jump into that now. Okay, so let's talk about an easy one first. VTS is a Vanguard exchange traded fund that tracks the US total market. I was always intrigued by the US market, but the transaction fees to trade individual US stocks are even more ridiculous than Australian stocks. So that wasn't really an option for me to pick individual stocks, but I still wanted access to the US market or some kind of exposure. So investing in VTS was a very cheap way for me to access the US market. The management fees on VTS is only 0.03%. It's very, very low. And the dividend yield is 1.22% as of recording this video. I'm not too concerned about the low yield because the purpose of investing in VTS is more for cheap access to the US market. So honestly, I'm not very fussed. Now with InvoCare, ResMed, and AMD, those are all the companies I personally really like and I wanted to own myself. Other than that, I actually don't have a logical reason why I have positions on those. I mean, InvoCare are one of the 2 listed funeral companies in Australia, and they are incredibly dominant in this space, owning 33% of the entire funeral markets. The stock itself is not fancy at all and actually quite boring if you tell other people about it. And it might even seem like it's slowing down or declining. But the thing is, they underwent a refurbished project from February 2017, which really impacted their ability to grow their earnings. But it's all for revitalizing their properties so that they can gear up for double-digit growth. And that project should be finishing very soon. So I'm pretty excited over the next few years to see how changes to their properties impact their earnings growth. Now with ResMed, I discovered this company because I have a very rough relationship with snoring. It comes and it goes, and we spend a big portion of our lifetime sleeping. So if you have any kinds of sleeping disorders or snoring problems like me, you really understand the pain these problems cause. Now, AMD is my newest addition that I want to own for the rest of my life. The CEO, Lisa Su, is an absolute beast. She brought AMD back alive ever since she joined the company in 2014, and now they are a legitimate competitor to Intel and Nvidia. Now, not only that, it's almost like she has a sixth sense in the way that she built liquidity in the balance sheet over the last couple of years. Now, she has gotten rid of majority of debt over the last couple of years. She stomached a lot of criticism Wall Street gave her for not leveraging enough to grow faster. And now she's making Intel nervous with their CPU chips. I just can't say enough good things about the team Lisa has built. Not to mention I'm a computer geek too, so I just absolutely love the hardware products. Now, what I mentioned about LICs and the other guys are really how I've constructed my portfolio. There's no fancy reason to it, and I'm still working on it. I can see the flaws, and I wanted to take you through my whole portfolio just so that you know that I'm aware of some of the downfalls on my portfolio and I'm actively working on it. So over the remaining of this year, I'm just gonna keep you updated in terms of what position I added, how I've reshaped or shaped my portfolio so that you can learn from my mistakes. So let's talk about some of the questions that you have asked me when it comes to dividend portfolios in Australia. Now, one of the more common questions when it comes to dividend investing is how are dividends paid in Australia? Dividends are paid to you in either cash or in shares. Now, if you didn't opt into dividend reinvestment plan, then it will be paid to you on the payment date disclosed by the company's dividend announcement. And I'll show you an example now. So as you can see here, this is Coca-Cola's dividend announcement in 2020. And as you scroll down, there's different key dates and you can see here there's a payment date. Now, if you didn't opt into dividend reinvestment plan, the dividend payment that is, will arrive in your account on the 15th of April 2020. And another really common question people have asked me a few times is how are dividends taxed in Australia? Now, dividends you received are treated as income, so you have to pay income taxes on it. But the amount of taxes you have to pay on that dividend income are dependent on two things. Now, one, the amount of franking credits you've received, and I'll explain that in just a second, and where you are receiving that dividend income. And what I really mean by that is the dividends you receive in your super fund is usually taxed at 15%, whereas dividends you received as part of your personal income will be taxed at your own income bracket. By the way, I'm not a professional by any means, so if you want proper advice, make sure you go seek out a professional. Now, on the point of franking credits, what you ultimately need to know is that there are two components within the dividends you get paid. There is a cash component and there is also the franking credits component. Dividends are paid out of a company's net earnings, which means that it's already being taxed at the corporate level. The company paying you a dividend have the option to pass the taxes they're paid on that portion of earnings you are going to get as dividends. And if they do, you receive franking credits along with your dividends. And that franking credit will ultimately reduce some of your taxable income. Remember earlier in the video, I actually talked about grossed up dividend yield. And also remember, just now I mentioned that there's two components to dividends. You have the cash component and also the franking credit component. Gross up dividends are essentially just the dividend yield that includes the franking credit component as well. Now, one of the last questions people ask me multiple times is how do you opt into dividend reinvestment plans? The easiest way to do that is to Google whatever the stock is plus dividend reinvestment plan. When you've done that, there'll be a set of instructions that you need to do to opt into that dividend reinvestment plan for that stock. So just follow the instructions, go all the way to the end and confirm, and then you'll be just fine. So thank you for watching this video all the way to the end. I'm hoping that I've shared an in-depth look and understanding to how I've built my dividend growth portfolio in Australia. And yes, it's not perfect and there's a lot of downfalls that I'm trying to work through at the moment. But hopefully, as I share more of my journey with you, you can learn from some of my mistakes and we can both grow together. As usual, make sure you gently destroy that like button, subscribe to my channel, click onto the bell so that in the next couple of days when I release another update on my US dividend growth portfolio, you'll be the first one to know. And until next time, he was actually here with me the entire time. See you next time.